Hi everyone, welcome back to another exclusive podcast from IronFX, where we're dedicated to bringing you the absolute best education to help you take your trading to the next level. In today's podcast, we'll be talking about where is the recession. Now, before we dive straight into the podcast itself, how do we define a recession? Probably that's a good idea to start this podcast so that we can all be on the same page and have a clear definition of what is an actual recession. Now, according to this agency in the US, which is the National Bureau of Economic Research, or the NBER, right? Basically, it is a committee that tracks the business cycle in the US. Now, this agency has defined a recession as a significant decline in economic activity that is spread across the economy, lasting more than a few months, normally visible in production, employment, real income, and other indicators. Now, this is a very technical description of what actual recession is, so let's try and break it down. Right, so they said significant decline in economic activity. Now we can define that as having more than 2 quarters of negative growth with respect to GDP, right? So we have more than 2 quarters of negative growth in GDP output, and then they also mentioned about visible reductions in production, employment, and real income. So one thing that stands out quite clearly in recession is high unemployment, right? So if we have a period where economic activity has declined or turned negative over a period of 2 quarters, and that is also accompanied by high unemployment, then yes, I think that's what we can define as a typical recession, right? So that's how the NBER, or the National Bureau of Economic Research in the US, has defined a recession. Now, we also have a technical recession. Now, what could that be, and how does that differ from the regular full-blown recession, right? Now, the technical recession is somewhat of a milder or lower version of a full-blown recession. So, in this definition, it is defined as a period of 2 consecutive quarters of negative GDP growth, right? So that means we've only seen a decline in economic output or economic activity, but we do see the unemployment rate being relatively low. So that means unemployment figures are still high. That means non-farm payrolls are still probably adding jobs on a monthly basis, maybe not as strongly as before, but we do see job gains instead of job losses on a monthly basis, while the unemployment rate has remained relatively steady. So that's how we can define a technical recession. Now, if you go back to 2022, this is what the US actually experienced in the first half of that year. So in the first quarter of 2022, as well as the second quarter, the US actually experienced a technical recession. That means negative economic growth actually declined over this period. However, unemployment rate remained relatively low, and the US labor market was actually still growing quite steadily. And then in the second half of 2022, economic activity actually accelerated. So, although the US experienced a technical recession in 2022, it did not lead to a full blown recession in the second half. Economic activity actually picked up, and the labor market continued to grow quite steadily. So, the US did experience a technical recession in 2022, but avoided a full blown recession in that year. Now, because the Federal Reserve was raising interest rates quite aggressively throughout 2022 and in 2023, many economists were led to believe that 2023 would finally be the year where the impact of higher interest rates would finally be felt on the broader US economy, right? Now, why did they come to that conclusion? Well, they were looking at several data points, right? They were looking at hard data and soft data in the US. Now, hard data refers to uh, PMI numbers, GDP output, as well as the labor market. And then soft data uh, can consist of surveys such as consumer sentiment surveys that are done by agencies such as the Conference Board and University of Michigan. Now, when economists were looking at such data points, right, they had I would say mixed data. There was a conflict of direction coming from these important macroeconomic data, right? So, let's just start off with leading indicators, right? So we had leading indicators such as the leading economic index from the conference board, as well as the ISM manufacturing PMI index, which showed recessionary signals throughout 2022 and in most parts of 2023 as well. They also had soft data such as consumer sentiment surveys from the Conference Board and University of Michigan, also showing similarly recessionary signals throughout 2022 and 2023. However, when we looked at the other leading indicators such as the ISM services PMI, and we look at a coincident indicators such as GDP growth, they actually showed expansion, right? And combining that data with the US labor market, actually the US labor market showed very strong resilience throughout 2022 and 2023 as well. So although the data was very mixed with some pockets of indicators highlighting recessionary signals, we had another segment of data which showed strong expansion, and at the same time the US labor market was actually quite resilient, right? So we actually avoided the recession was actually avoided in 2023 due to a very strong labor market and also due to a strong services sector and overall economic growth in the US, right? And part of the other reason that reminds me now comes to tech layoffs, right? Towards, if we remember, back in the end of 2022 and early 2023, a lot of the big tech companies such as Apple, Meta, Google, embarked on a pretty strong layoff or retrenchment program, right? So there were many layoffs that were reported by the media over this period, right? So we had a big tech layoff at the end of 2022 and early 2023, which also spiked some concerns with regards to the strength of the labor market. Another way to track the strength of the labor market, besides the NFP job gains and the unemployment rate, is also to look at initial jobless claims, which are also known as unemployment claims. Now, the difference is this unemployment claims or initial jobless claims are released on a weekly basis, whereas the NFPs and unemployment rate are released on a monthly basis. So we can see that jobless claims come in much more regularly and is something that we can track more readily as well. So when we looked at the first half of 2023, initial jobless claims actually started to trend higher, right? So they were trending higher for the first half or the first 2 quarters, primarily led by the tech layoffs that occurred at the end of 2022 and early 2023. However, in the second half of 2023, initial claims then started to reverse trend and drop lower. So we actually saw the US labor market become resilient in the second half of 2023. So even though in the first half we saw incoming data that would suggest that the US labor market is about to crack or break, that did not occur. The trend actually reversed in the second half of 2023, which is also part of the reason why we did not see a full-blown recession, right? So as we mentioned right at the start of the podcast, a full-blown recession consists of negative economic growth as well as high unemployment. Now, both of which did not occur in 2023. Now that brings us to this year, right? 2024. Could we finally see a recession this year? Well, we just saw the latest January NFP numbers come in very strong. NFP numbers posted job gains of well over 300,000 versus the estimate of about 190,000, while the unemployment rate remained steady at 3.7%. And when we also look at the unemployment claims or initial jobless claims from the last quarter of 2023 to the current period in January and February, we do see trends have the trend in this is still towards the downside, right? Although the last 2 weeks unemployment has started to pick up a little bit over the last 2 weeks, right? This I'm talking about initial jobless claims or unemployment claims. So far, the data does show economic activity to be growing quite strongly, as seen in the recent GDP data. ISM services PMI is still strong. The labor market is still resilient as well. Well, could 2024 finally be the year where we experience a full-blown recession? I certainly hope not, because that means a lot of people are going to be out of jobs, and I wouldn't want that to happen. But we do need to be prepared in the event such a scenario takes place. One way to do that will be to look at the state of the US labor market, right? If you look at non-farm payrolls and the unemployment rate on a monthly basis and see how strongly non-farm payrolls are growing, and combine that with initial jobless claims or unemployment claims on a monthly, weekly basis, and if we see these claims start to trend higher on a weekly basis, then that could signal a potential concern with regards to the US labor market. Because if the US labor market breaks, and what do I mean by breaking? That means when the US labor market starts to actually embark on a very strong retrenchment program that leads to higher unemployment rate, higher unemployment claims, then that could typically lead us into a full-blown recession, because that means eventually companies are going to produce less, whether you're in the manufacturing sector, services sector, and when people are out of jobs, they're going to naturally spend less as well on goods and services. So that is something to take note of. Keep an eye on the US labor market, because that is probably going to give us one of the first major clues as to whether we end up in a recession in 2024. Right. Anyways, that's all from me for today's podcast on Where is the Recession. Do remember to subscribe to our podcast here at IronFX, where we are dedicated to bringing you the very best education to take your trading to the next level. Until then, stay safe and trade safe.